options enthusiasts, I'm here to record another session of options trading basics, the session 3. Over here you will be learning all these agenda in today's video. So today what you will be learning is who are the participants in options trading markets, why use options to trade in markets, how does options work, details to know before moving to Greeks, the Greek terms, and the likely factors influencing the pricing of options. So let's jump into the first topic, that is who are the participants in options trading markets. So we can say there are four types of participants in options market. They are the buyers of calls, sellers of calls. Sellers of calls are also called as call writers, and buyers of puts and sellers of puts also called as put writers. So let's jump into the next topic, because this is almost self-explanatory. Who do buy the calls? The people who rather want to hedge their portfolio, or the second type of people are like me, who just buy the calls and buy the puts to make profits in a daily basis. And the second topic is why use options to trade in the markets. That's because I get to trade a share in one market lot at a piece of a price of the share traded price. To buy one lot of Nifty, I would need around 61,000 to 70,000 depending on the broker to buy one lot of Nifty in futures. And to buy an in the money call or in the money put with respect to 100 rupees premium option, I would only require around 7,500 in the market. That's the best part about options, and you can still make around 1,000 to around 5,000 rupees on a daily basis, provided you are trading in the right mindset. So how does options work? In the money call, in the money put, out of the money call, out of the money put, and at the money call and at the money put, including the examples. So let's see what are the different terms in options. The first one is in the money options. So what is in the money? So in the money means that a call options strike price is below the market price. So the strike price should be below the market price or of an underlying asset which we are considering, or that of a strike price of a put option is above the market price of the underlying asset. Being in the money does not mean you will profit. It just means that option is worth exercising. It means that you are good to buy the in the money call or put, because it actually has the delta which moves in tandem with the underlying asset. So how much ever the underlying asset moves, the in the money also moves almost that much. I'll teach you what is delta. However, we'll look into that in the next slides to come. And now it means that it is worth buying or worth exercising. This is because option costs money to buy. For example, if it is in the money call or in the money put, if it is worth 150 rupees in premium, you have to have 150 multiplied by 75 to buy that particular Nifty options call or a put. So that's the value of money you need to have in your account to trade with this. So let's see an example. Spot price is 10,331 and strike price is 10,200. So let's calculate if it is in the money call or in the money put. So let's see if it is in the money call, the strike price minus spot Nifty price should be negative, and let's minus 10,331 by 10,200, so it becomes a negative. It means that it is an in the money call. So let's calculate for in the money put. The strike price minus spot Nifty price should be positive, whereas this is negative. So it means that it is not an in the money put. Now let's see what is an at the money call or at the money put. ideally, so this is what is ideal. However, this ideality never works all the time. Okay, it works, but it does not work all the time. So what is an at the money call or at the money put? At the money is a situation where an option strike price is identical. For example, if stock, that is XYZ stock, is trading at 75, then the XYZ 75 call option or a put option both are at the price of 75 itself. So the strike price and the price of the stock are both are the same. That's at the money call or at the money put. So let's look into an example. Spot price is 10,350 and the strike price is 10,350. So it means that we can buy at 10,350 call or 10,350 put, and the spot price is 10,350, which ideally means that it is at the money. So out of the money, what is out of the money? Out of the money is term used to describe a call option with a strike price that is higher than the market price of an underlying asset, or a put option with a strike price that is lower than the market price of an underlying asset. An out of the money option has an intrinsic value. I'll teach you what is intrinsic value in the future classes. Only possesses extrinsic or time value. So what is time value? I will teach it in the future slides in this video itself, so keep on watching till the end. Basically, what is an out of the money? Let's look into an example and find out. Okay, if it is an out of the money call, what does that mean? It means that out of the money call's strike price is above the value of the underlying asset. It means that it is above the value of underlying asset. Let's take an example that spot Nifty price is 10,331 and strike price is 10,200. So what does that mean? Let's see. Strike price minus spot Nifty price should be positive for an out of the money call. It means that 10,200 minus 10,331 becomes negative, which means that it is not an out of the money call. Let's calculate for out of the money put. Strike price minus spot Nifty price. If it is negative, it is supposed to be called an out of the money put. So 10,200 minus 10,331 means that it is negative, so it means that it is an out of the money put. So let's move on to the next one, the details you need to know before moving to Greeks. Expiry of options. What is expiry? Nifty and the stock options expire every last Thursday of the month. It means that every last Thursday of the month is called as options expiry day. If it is a holiday on Thursday, it gets preponed to Wednesday. If it is a Wednesday holiday as well as Thursday holiday, it gets preponed to Tuesday. So if it is the whole week's holiday, it becomes the last Friday of the month, which is an expiry. So it keeps on preponing as and when there is holidays for consecutive days of the last day. Only the bank Nifty options in India is currently having a weekly expiry currently, and it expires every Thursday. It means that it is more volatile than Nifty or the stock options. Time decay. So what does that mean? As and when the expiry nears, the option price decays with respect to at the money and out of the money calls or puts. So what does decay mean? First of all, decay means it reduces or it goes down in price. That's what decays means. Strike price of an option. It is the speculative price point or a level at which an option, a call or a put is currently buyable. So what does that mean? A strike price is the level of the option which is preset. For example, there are 22 levels above the current price of the underlying asset and 22 levels below the current underlying asset's price point. There are strike prices defined. So for example, if 10,330 is the level of Nifty is having 50 as multiples for the options, so there will be 10,300, 10,250, 10,200 and 10,350, 10,400, 450, 500, like that. There will be 22 strike prices above this and below this, which will be available in the market ever to trade. So whenever the price of price of the underlying asset keeps on moving, the strike price of the option also keeps on increasing or decreasing in the value. So 22 is a fixed price, 22 is a fixed number where it won't change. So whenever there is the change in the value of the underlying asset, the 22 above and 22 below keeps on getting triggered. Next is the price volatility of the underlying asset. It is the value of the underlying asset moving higher or lower on a particular day. So higher the volatility, more ups and downs we see in the underlying asset. Lower the volatility means that less ups and downs, which also means that it is becoming monotonous in movement of the particular underlying asset. Let's move on to the next slide. The Greeks. The first in Greeks is delta, which also is represented by a triangle. So what is delta? Degree of change in option value with respect to the value of the underlying asset. So what is the degree of change in options value? So how much of a value a option will change with respect to the underlying assets value is determined by delta. So let's see with an example. Delta never would go below 0 or above 1. It always tends to go from 0 to 1 and always remains in between 0 to 1. It never goes above or below this. Delta measurement value. So if the price of the natural gas changes by 1 unit and the option value, the current premium, changes by 0.4, then what's the option delta currently? So the value of the option is 0.4. So the delta value is 0.4. Delta of an option approaches 0 as option moves deep out of the money, and delta of an option approaches 1 as option moves deep in the money. So Vega. What is Vega? Measures the effect on the premium with a change with respect to the future volatility. So the effect on the premium of the option with respect to change in the futures volatility is the Vega. So Vega also is referred to as kappa. The degree of the change in options value relative to a change in the price volatility of an underlying asset is what is called as Vega. Vega is closely followed by traders since trading options is viewed as trading volatility. So what is gamma? The rate of change of delta. So how fast and how slow change of delta happens. That's what is gamma. An indicator of how stable the delta is measured by gamma. If a position or a portfolio has a very high gamma, what does that suggest? It suggests a value of options is reaching deep in the money or deep out of the money. Let's analyze this. Rate of change of delta. So delta may go higher or delta may go lower. What does that mean? If delta goes higher, it means that it is going deep in the money, because in the money means that delta is almost near to 1. Deep out of the money means delta is almost near to 0. So the rate of change of delta, if it is increasing, it is moving towards deep in the money. If it is decreasing, it is moving towards deep out of the money. So the last Greek is theta. Measures the effect on the premium with respect to the change in time to expiry. What does that mean? The degree of change in option value in relation to the change in time to expiry. Let's analyze this. It is the degree of change in option value, how much the option value changes as it nears to the time expiry. For example, it may go higher or it may go lower, because it may go deep in the money or out of the money. So that's what it means. So how much the value of option changes with respect to the time to expiry is what is theta. It becomes more important closer to expiry, because it is the value which is determined very near to the time to expiry. So what does high theta on a call or a put option means? It means that the premium is either moving up or down really fast with respect to time nearing to the expiry day. So let's move into the last but not the least factors influencing the pricing of options. What are the variables for the influencing of pricing options? Those are price volatility of an underlying asset. I will show you how to determine the price volatility of the underlying asset. The next thing is duration of the option, which is time to expiration, how near it is to the time to expiration, how far is it from time to expiration. Strike price of the option, it is very important, because I have already told you, as and when it goes deep in the money or deep out of the money, that is when the strike price gets more into action over there. Value of the underlying commodity or an asset, if it is going higher or if it is going lower, that is when the options gets higher or lower, depending on if it is a call or a put. Now let's see how to measure the value of delta, gamma, theta and vega. And all these are very simple. You just have to select. I have already pre-selected this. How can you get this? You can go to tools and go to calculator, select option calculator. You will find this information here. This is what I have already selected. It is 31st May 2018, which I have selected as the expiry date. I have selected the call and I have selected 10,700 as the strike price. Volatility is 11.8753 for this particular call strike price. So what is the value of delta? Delta is for a call is 0.4593 and for a put it is 0.5407. For this particular strike price it is giving both, right? And for a gamma is this value, theta is this value, vega is this value and rho is this value. So what is volatility? Volatility is 11.8753. so this is the easiest way how you can verify if the delta is good enough for trading or volatility is good enough for trading on that particular day or not. Thank you very much for hearing me all this while, and If you are interested to learn about Nifty options intraday trading, then you have enroll in my Nifty options intraday trading course. So why is that? What will you get out of that? I am an options trading coach. I have been trading in options with my own strategy for last 5 years, and I only teach options intraday trading as I expertise in it. I am an expert in that field. I would teach you 3 strategies for options trading. One is the contra trading, traded in the first 15 minutes. Second is scalping, can start anytime when you start trading. Third is the trend trading, the combination of 6 indicators of a good trend for which we will know the target, stop loss and the risk to reward before the entry with 85% success rate. So having said that, I bid adieu to you. So if you have questions, please do reach out to me at ashok.rao@exoticinvestment.com. If you like this video, please give a thumbs up. Don't forget to subscribe to my channel. Please do comment on the video about all your thoughts and your feedback. Thank you. This is Ashok Kumar signing off. See you, day traders and options traders and enthusiasts. Subscribe to my channel. Don't forget. See you. Ashok Kumar signing off.